Okay, so we're going to do something different today. We're going to talk about basic financial, literacy. Start over.
I'm going to start the whole thing over.
Yeah.
Okay. Take 3.
Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we're going to do something different today. We're going to talk about basic financial literacy. These are terms you should know. What we want you to do are 2 things. First thing is, at the end of the video, after you've watched them all, tell us how many of these terms you knew.
Right.
Like when we say a thing, you could say, okay, I knew that, didn't know that. And we'll have a little contest, see who knows, who like knew what all these were.
Right. But, we really need your help right now. We need you to like, subscribe, and share the video because we're trying to grow our YouTube family, so we appreciate your help. So let's go.
Yeah, you'll have more people to have fun with in the comments.
That's right.
Okay. So what we'll do is we'll take turns going through these. We'll talk about them. These are, the path to wealth is understanding how markets work, how finance work, and all of this. You have to understand these terms or you won't be able to really understand how to, be wealthy.
Right.
So the first one, these are in sort of alphabetical order. The first one is a 401k.
Okay, so 401k is a retirement plan, right? You get to contribute to it pre-tax dollars.
Okay.
It grows tax deferred, and you get to withdraw from it when you retire. You can also borrow against it for education, for buying a home, and best of all, your employer can also contribute to your 401k. If you don't have one, check with your employer, see if they have an employer-sponsored 401k. If you are self-employed, you can have a self-employed 401k. Lots of different programs out there. Check it out.
Yeah, there are Roth 401ks too. Well, that's a bonus thing we'll talk about at some other point. The advantage about 401k is the contribution limit's really high.
Right.
You can put a substantial amount of money in a 401k.
And if you're old like us, you can do catch-up contributions. Really cool.
50 and over, which barely qualify. 50 and over,
Yes.
catch-up contributions. Okay, an APR.
APR, annual percentage rate. So you see this all the time in car advertisements, and you maybe see it on your credit card. It just has to do with the interest rate that you are being charged on an annual basis.
A bond.
A bond. And we're
not James Bond.
I was going to say shaken, not stirred.
Oh, I should have brought the book. My kids bought me a little James Bond picture book with quotes in it.
Okay, so tell us about bonds, Todd.
Bonds are debt instruments. Corporations issue them. Governments issue them. The bond has basically a coupon rate, which is a percentage rate, and then it has a term, how many years. And what happens is you buy this bond, and at the end of the term, not only do you get all your money back, but then you get all of the interest back. The nice thing about bonds is you can trade them. You can actually take your bond and you can go sell it to somebody else and retrieve some money back for it. If interest rates have gone up, your bond is probably worth less. And if interest rates go down, your bond is worth more. That's advanced.
Right. So there are lots of different kinds of bonds. There are government bonds. There are corporate bonds. There are municipal bonds, junk bonds, lots of different kinds.
James Bond.
James Bond. Yes. So lots of different kinds of bonds. Moving on.
Budget. What's that?
Okay.
Is that where it's a rental car?
That's right. It's a rental car, but it's also your financial game plan, right? How much do you make versus how much do you spend, and what you're saving and all of that. So making sure that when we talk about the budget, that you do not spend more than what you bring home.
That's probably the most important thing, is living within your means. I can just say that.
So please don't spend like the government.
Yeah. Read the book Millionaire Next Door.
Yes.
You find it at your local library. You don't have to buy it. It's probably free online anyway.
Yes.
Wanda, what is cash flow?
Ooh, cash flow. This is really important. So we know about cash flow, right? Because you know that you get paid on a certain date, and then you have these bills to pay, and then you have other bills that maybe you don't quite have the money to pay those yet, and you need to wait for the next paycheck. So it has to do with money in, money out.
Okay, yeah, it's pretty simple. For your checking account, it would just be if your checking account is increasing, you have positive cash flow. Okay, and unless you're, of course, like not paying your debts, then that's probably bad. Certificate of deposit.
Okay, so certificates of deposit, most lending institutions have them. So, for example, if you bank with Bank of America, Wells Fargo, Chase, whomever, they'll issue you a certificate of deposit. That means that you give them money, And after a certain amount of time, a year, 5 years, 10 years, whatever your certificate of deposit is for, at the end of that time, you can redeem your deposit and you get your principal back, plus you get whatever interest rate that certificate of deposit carried.
The bad thing about it is you can't liquidate them early.
Correct.
There's no secondary market to sell them. You just pay a penalty if you pull your money out
Right.
early.
So you lose part of the principal and all of the interest if you pull your money out early.
Okay, what is a debt to income ratio?
Okay, so debt to income ratio, this is
What's
really
that?
important. Lenders use this a lot to make lending decisions on your behalf. So it means that, for example, if you make $100 and you have, so that's your income, and you have debt to service, right? So how much money you're paying out, that would be, for example, let's say that you have $70 worth of payments to put out there, so your debt to income ratio is 70-30, not a great debt to income ratio.
70%.
Right.
And where this really is buying a home.
Right.
It can't exceed a certain number usually. They won't let you borrow money. That's why you can't just buy a house that's 100%, takes all of your income.
Right.
Okay, what is a down payment?
Down payments is the amount of payment that you are putting up front. So for example, if you're buying a house for $100,000 and you are putting 10% down, that means that you're putting a $10,000 down payment. That goes against the purchase price of the house. So that means that your loan will only be $90,000.
Okay, good. And this could be down payment for anything. It could be for a car. It could be for, the stores do down payments. When you put something on layaway, that's a down payment.
Right.
Compound interest.
Ooh, this is really cool.
This is super cool.
Super cool.
It's Mark Twain said it was Einstein. Albert Einstein's the most powerful force in the universe is compound interest.
There you go. So that means that if you have $1,000 in the bank and you're earning 10% interest on your $1,000, then next year you will have $1,100, and if you keep earning 10% interest, now you will be earning 10% interest on $1,100, which is very cool.
Yeah, because the interest is earning its own interest.
That's right.
And it just keeps growing. That's how,
That's how you put your money to work.
So you put your money to work. What is a credit history?
Ooh, so this is the history of usually your payment history. So, so it reflects your on-time payments. It reflects any late payments. It reflects any delinquencies. So it's just a history of your borrowing and the level of responsibility that you've shown regarding your finances.
Hopefully you've been responsible.
Yes.
Toward your finances. Because if not, it shows in the next one, the credit score.
Right. So there are lots of credit scores out there, and we've talked about this before. There are lots of them. They're used for different purposes, and all of them are pretty close. And then, of course, each credit reporting agency calculates your credit score a little bit differently. But the bottom line is the credit score is kind of a snapshot of your credit history and your credit worthiness.
Yeah, it's just a number. It just they look at everything and they just they stick a number on it.
But remember, because they have different credit scores for different purposes, different parts of your credit history are weighed in different ways.
Okay. What is an emergency fund?
Ooh, very important, very important. Whether you are a homeowner or not, you need an emergency fund. This is money, not mad money, for spending or for the Thanksgiving weekend spending. But this is money to cover unforeseen expenses, money to cover things like maybe if your car breaks down, or if you lose your job, or if you have some sort of a health emergency or something like that. This is money that doesn't get touched. It is your emergency money for a catastrophic thing that happens.
Employer-sponsored retirement account.
Ooh, very cool. So there are lots of different employer-sponsored retirement accounts, like PERS. Those are for the ones that are sponsored by governmental entities. So, for example, if you work for the state or if you work for the federal government or something like that. So they have an employer-sponsored retirement account. Most of us have 401ks, and those are the most popular ones for you and I, where our employer sets up the 401k and maybe even contributes to it, they usually contribute some sort of percentage, either based on your wages or your contribution, whatever formula they have. So there you go.
Yeah. Interest rate.
Interest rate. This is how much money you're either paying to borrow money or how much money somebody's paying to borrow money from you.
Yep. And there's different interest rates for different things.
Right.
College loans, car payments, home payments, they all have different interest rates based on risk and things like that. Yep. What is investing? Investing,
that's putting your money to work. So you can invest in stocks. We've talked about bonds. You can invest in real estate. You can invest in commodities and all kinds of things. All investing is putting your money to baseball cards. There you go.
Cryptocurrency.
Yes, it's putting your money to work.
Okay. What is a Roth IRA?
So Roths are really cool. So Roths are great, particularly for younger people, because you can put the money into a Roth. Roth is a retirement plan, right? It's a retirement instrument. So the cool thing about a Roth is that you put the money in there and it's post-tax, which means you already pay taxes on it. Now, if you're usually a young person, you probably make a little bit less money, so you're in a lower tax bracket, so you don't mind quite so much paying taxes on that, because what happens on the back end, when you retire, all the way at the end, you get to withdraw that money plus the proceeds from all the investments of that money tax-free. Very cool. So that means that your money grew, and the whole investment then is not tax deferred, but it's tax free. So it's very cool.
How powerful this is that this famous investor named Peter Thiel made an investment in a company called Airbnb. Mm-hmm. He was the very first investor, and he made it from his Roth IRA. Mm-hmm. So when the company went public, his shares were worth about $5 billion, and it was all tax-free.
Very cool.
Because it was in his Roth. Yes. Okay. What are stocks?
Okay, stocks are investments in publicly traded companies, right? You own a piece of the company. And you can buy a whole share, a fractional share, depending on the company. You can buy them through your retirement plan. You can buy them through your brokerage account, all kinds of ways that you can buy stocks.
Traditional IRA.
Traditional IRA, that is where you're contributing pre-tax money. So that means that you don't get taxed on the money. You get to put it in the IRA. There is a limit. It's $6,500 this year. And you get to contribute that money. That money then stays in your IRA, gets invested, and then when you retire, you can withdraw that money, and now you have to pay taxes on the money that you withdraw, both the principal and whatever growth that money has generated.
The nice thing about traditional IRA is anyone out there can open one. You just go to your bank and say, I want to open an IRA. They open it for you, and then you just put money in it. And then when you file your taxes, there's a line that says, how much did you put in your IRA? And you put $5,000, and then you don't pay the taxes on the money. You get to save it tax-free. The bad thing is you just can't take it out to your 59 and a half.
Right.
But if you're 20 and you put $5,000 in an IRA, then it's probably going to be a ton of money by the time you have 59 and a half.
Right. The limitation on that is, like I said, $6,500 this year, and you cannot put more in there than what you earned. So for young people, keep that in mind, that maybe if you didn't earn that much money and somebody wants to give you money, that's great, but you can't put in there more than what you earned.
So those are all of them. Let us know how many of them, if you knew them all. Most of our regular viewers probably got them all. They're pretty sophisticated. Mm-hmm. And hopefully you learned something from it. But if you're interested in real estate, subscribe to the channel.
Right.
This is because we mostly talk about real estate.
Right. So if there are some terms out there that we should have mentioned and we didn't, please let us know in the comments. We would love to know. And we appreciate your support. We appreciate you sharing, liking, and subscribing to the videos. And we will see you on the next video. Bye.
Bye.